This is a time more than any other time to be thinking about offloading investments that don't serve you. Hi there, Salena Kulkarni here with another episode of the Freedom Warrior podcast. It is my job each week to share with you the strategies, expert interviews, and people's stories around the topic of wealth and financial freedom. I'm really excited about this episode today. I really want to unpack for you some of my views after having studied the subject of investing and wealth creation for the last 20 odd years. I specifically want to talk to you about what is it that is required to succeed as an investor, even when the market is declining? So, look, for those of you who want to learn more about financial freedom through alternative methods, please head over to my website, freedomwarrior.com.au, where you can access my library of articles, interviews, and programs to help you on your journey to becoming financially free. Now, let's get on with the show. So I have made a couple of notes here today, just so that I don't do this, I do this in a bit more structured way rather than meandering as I tend to do. And, really the question that has come up for me through a series of discussions with various clients over the last probably 3 months is, how do you position yourself defensively when the market turns to custard? There's no question there's some dark clouds on the horizon. I've said that before. However, I think the reality is, because the types of interventions and the experience that governments have right now, it puts them in a unique position of being able to pull different levers to make different things happen. There's a lot of people out there saying it's all doom and gloom. There's a lot of people out there saying that the market is going to tank. And to be perfectly frank, there's people out there who I personally regard as very sound economists, who are spouting off all these ideas about what they see happening in the market. But the reality is, the government could come out of left field with a reform or a legislative change or some support mechanism which totally counteracts anything that happens in terms of fractures in the economy. So I think the reality is, you just can't crystal ball gaze. You can't accurately say that this will or won't happen in the future. Like, for example, you cannot say categorically that the property market is going to tank, because you simply don't know what measures are going to be taken to sort of counteract that. If things were left to, normal open market conditions, then yeah, maybe the market would tank. But I think the game that an investor needs to play isn't trying to predict what will happen. It's actually trying to position yourself defensively so that regardless of what happens in the market, you are protecting what you have and positioned to exploit opportunities as and when they arise. I think there's a number of attributes that I would talk about in relation to, how to thrive in a declining market. But I think the first thing is really just getting your house in order. So the number one rule of thumb for, positioning for a potentially a very turbulent time is keep sufficient cash reserves on hand. I think when we're in our younger or our earlier days of investing, or even if we're just a bit of a risk taker, we can have a tendency to push to the limit. And I know I've certainly done that in the past, where, I've kept minimal cash reserves on hand with the view that, I can do better in the market. The opportunity cost of keeping cash reserves on hand was just too high. And I think during boom times, perhaps you can get away with that. But I'd certainly be encouraging people to look at keeping, at least 3 to 4 months of living expenses on hand, if they can, in order to protect against any, major area of turbulence. there's no question that what's happened during 2020 has kind of come left of field in a way. Although a lot of people were predicting a market reset, an economic winter, all those things, because we'd had such an amazing bull run. I don't think anyone could have really predicted that COVID would hit and that it would have the impact, the global impact that it's had. So, for some people who've been caught off guard, not having enough cash reserves has really been, a super painful lesson. And certainly if you're in a position to correct that now, I highly, highly recommend. I think the second thing I would say is, one of the ways to position defensively in a declining market is to make sure that you hold enough investments that generate cash. Not all of us have gone down the path of, purchasing investments that deliver good cash flow. But for anyone who's really serious about creating wealth over the long term, now more than ever is the time to be thinking about, well, are my investments going to serve me? Are they generating enough cash to at least hold their own, if not put money in my pocket? The third thing that I would say is it's really important to be tracking the lending on the credit environment. I think that says a lot about what's going on in the economy. The banks are amongst some of the most conservative and I would say behave in a very selfish way. And so if you can track what's happening with the banks, I think that's a really great barometer for keeping track of what's happening in the market. If the banks are, freely giving away loans, or it's not that hard to get loans, I think that's a sign that their research and their confidence is very high. If lending is becoming more challenging, if it's becoming, more and more challenging to get loans across the line, if the paperwork required, if the things that you've got to satisfy go up, the number of, things that you've got to tick off go up, then, that's another sign that, maybe the banks are feeling a bit nervous. And, there's no question that the property markets are very much driven by the availability of credit. So I think keeping an eyeball on what's happening in that space, whether or not you intend to borrow, is actually a really useful exercise. The next thing that I'd say is that this is a time, more than any other time, to be thinking about offloading investments that don't serve you. Now, I said before, holding enough investments that generate cash. But in spite of that, as an aside, if you've taken the strategy of I'm going to invest in capital assets that have a primary focus on rising capital values, and I'm happy to bear the cost of negative cash flow, but you're looking down the barrel now of potentially not having either the capital growth or the cash flow, I think it's time to really kind of make some hard decisions about whether those investments serve you. Now, if you're in the luxurious position of earning a high income and you feel you can carry those investments, then by all means, feel free to do that. But for the vast majority of people, for the average mum and dad investor who is really using property as a means to create an asset base for themselves, it's really important that you don't overextend yourself. And now more than ever is a time to be thinking about, have I overextended myself? What can I do about it? Nobody likes to sell under duress. I totally get that. But sometimes if you project forward, you also account for the sleep at night factor and the stress, then sometimes selling does in fact make sense. There are lots of people who believe you should purchase investments and never sell. And, I would argue that I think that's old-fashioned knowledge and old-fashioned wisdom. The idea around investing is to create a portfolio of assets that actually serve you. And if those investments stop serving you, it's really important to, really think about the impact of holding and what that's doing to your lifestyle. There was a point in time, maybe 20 years ago, when that wisdom came to the fore, which is never sell, buy, never sell. And, in a rising market, I can see why people had that philosophy. But I also think that we're a country that's gotten a little bit drunk on the idea of making wealth through, capital growth. And many of us have been prepared to tolerate fairly negative or, poor cash flowing returns in order to achieve that. And don't get me wrong, there's been plenty of people who've become millionaires over the last 20 years as a result of that philosophy. What I'm saying to you now, though, is given where we are, it's a time to just take stock. There's a great expression, I'm trying to remember the exact language, but it's something along the lines of in a rising tide, all turds float to the surface. And the context in which I've heard that used is that in a rising market, it almost doesn't matter if you make a bad investment, everything will rise. But when the tides turn, that's often when you're left high and dry. In a turbulent market, certainly, not all properties are going to be successful. Just in summary, I think, in spite of the mentoring and advice and wisdom that you may have received till now, if you are really struggling and in financial pain and really looking to understand how to position to not only survive but thrive in a declining market, then you need to look very intently at each of your properties and work out whether or not it's serving you. I guess leading on from that, one of the things that I would say is, thriving in a declining market is about recognizing that it's not the time to be chasing or relying on capital growth in the traditional sense. I think, as I said before, I think we're a nation of people who rely heavily on the capital growth, even in commercial real estate, where often people purchase for cash flow. There's an element of requiring those assets to grow over time because the cash flow isn't terribly exciting. Even in commercial property where you might have a gross yield of 6 to 8%, an income stream of 6 to 8% in comparison to residential property, which can kind of average 3 to 5% before expenses, I might add. It's a pretty dismal amount of cash flow. And then you take out your holding costs and your loan costs and all of that, and you're really not left with a whole lot. So I think one of the things to be mindful of when you're thinking about new investments to undertake is there's a lot of people out there saying, buy, no matter what, property will always go up. And, if you take the long-term view, then that is certainly true. But if you're looking to position in a way that you'll be very comfortable over this next block of time, regardless of what happens in the market, I would suggest that I would not personally be getting into deals where I'm heavily reliant on growth in the future. I want to position myself in a way that doesn't, require me to keep pumping and working in order to support my investments. I'm at an age and a point in my life where I want the balance between my investing and my lifestyle to be, fairly healthy. And I certainly don't feel you can do that if you're chasing capital growth. And I think the ultimate upshot of a lot of this is now is the time to be focusing on how to increase your cash flow, recognizing that we can't crystal ball gaze. We don't know what's going to happen in the future. Property could go up, down, sideways. Someone will be right. But if you can find investments which deliver good cash flow, where the capital growth, if and when it happens, is a bonus, or where you have a capacity to create forced appreciation as opposed to organic, natural capital growth as a result of a rising market, they're the investments and the strategies that are going to put you in a position where you can basically swim along with the flow of what's happening economically and not put yourself in a position of too much stress. In my world and the investors that I work with, it's all about finding the opportunities where I can get cash flow, I'm not heavily reliant on capital growth. I'm not reliant on, I'm not concerned about massive economic turbulence, because these are properties which people want to live in, that are affordable housing, that are not really going to experience much up and down over the next 6, 12, 18 months. And, which, if anything, are negatively correlated to what happens in, the rest of the market and economically. So, look, I think really I'm just scratching the surface of it. But, I think positioning yourself defensively is super, super important in the next 12 months. If you think about strategies and tactics as falling into defensive and offensive, you have to play defense first right now. You can't be out there. You can't be motivated by FOMO. It's a great tactic used by lots of educators to try and get you to continue to buy. But FOMO is something, if you know that you're susceptible to FOMO, I'd be hosing that right back right now and focusing on, how do I position defensively? How do I look after the assets that I already have? How do I protect my income? And all of those sorts of things. So anyway, I hope my meandering thoughts have been useful. I'd love to say thanks very much again for listening to the Freedom Warrior podcast. And just a few things before you take off. Firstly, if you enjoy this episode, please don't forget to subscribe to avoid missing out on future episodes. Also, I'd really appreciate if you could rate and review my podcast just to help more people find it. Also, each week I've been sending out a unique newsletter where I share with you some of the most interesting things I've found through the week in relation to financial freedom. Could be an article, a favorite product, an interview, and so many more things. And finally, if you're interested in fast tracking towards being financially free, I run a series of programs where I can help put you on the path to generating a significant six-figure passive income through investing. If you're interested in learning more, please head over to freedomwarrior.com.au to find out if it's suitable for you. Till next time, see you on the next episode. Bye for now. Thanks for listening to the Freedom Warrior podcast. First of all, if you enjoyed this episode, please don't forget to subscribe to avoid missing out on future episodes. If you're interested in fast tracking towards being financially free, go to freedomwarrior.com.au, get in touch, and look forward to catching up with you next time. Take care.